Hello everyone, welcome back to the channel. Today we are diving deep into a company that's a giant in Singapore's tourism scene, Genting Singapore. On August 7th, Genting just released their financial results for the first half of 2025. And let me tell you, it's a really interesting story. It shows a company right in the middle of a massive, and I mean massive, transformation. We're talking about their multi-billion-dollar project, RWS 2.0. So the big question for all of us is, are these current growing pains just setting the stage for an incredible comeback? Or are there some deeper issues investors should be worried about? We're going to unpack all of it. The revenue numbers, the profit drops, and most importantly, what this all means for the stock. You'll want to stick around for this one because the details really matter. But before we get into the nitty-gritty, just a quick heads up. This video is for informational purposes only, and it is definitely not financial advice. Please always do your own research or chat with a licensed financial advisor before making any investment moves. Okay, let's do this. First off, who exactly is Genting Singapore? If you're new to the name, they are the powerhouse behind Resorts World Sentosa, or RWS. And trust me, this is way more than just a casino. It's a huge complex with Universal Studios Singapore, the incredible SEA Aquarium, which is becoming the new Singapore Oceanarium, plus world-class hotels and all the fancy shops and restaurants you could imagine. They operate in a pretty unique market. Singapore is a massive global travel hub, but the competition is, well, fierce. Genting isn't just competing with Marina Bay Sands down the road. They're competing with destinations all across Asia for those precious tourist dollars. And right now, they're doing all this while undertaking the biggest facelift in their history, a $4.5 billion project to completely renew the resort. Okay, let's get to the part everyone's been waiting for, the numbers. How did Genting Singapore actually do in the first half of 2025? Well, the main headlines show a bit of a strain. Revenue came in at about $1.2 billion. Now, that's a 10% drop from the $1.36 billion they made in the same period last year. Net profit saw an even bigger dip. It fell 34%. Ouch. That brings it down to $234.7 million. And because of that, earnings per share also fell to 1.94 cents, down from almost 3 cents this time last year. So on the surface, yeah, those numbers look a little worrying. A double-digit drop in revenue and profit is never what you want to see. But the story here is all about context. And on a positive note, the company did decide to keep its dividend at 2 cents per share. That's usually a good sign of confidence in the long run. So where did the weakness really come from? Let's break it down a bit. First, gaming revenue. This is their bread and butter, and it took a hit, falling 12% to $839 million. The company is basically saying this happened because a huge surge in travel demand they saw in early 2024 just wasn't there this year. Non-gaming revenue also dipped. Hotel rooms, for instance, were down 19%. This makes sense, though, as they're closing down entire hotels like the Hard Rock Hotel for major renovations. But, and this is a big but, it wasn't all bad news. The attractions, things like Universal Studios Singapore, actually did pretty well. Revenue from that segment went up by almost 2%. This was thanks to the super successful launch of the new Minion Land back in February. So you can see a really clear picture here, right? The main casino and hotel parts of the business are feeling the heat from all the construction, while the theme park side is showing it's got real strength. So, how did all this stack up against what the experts were expecting? Well, in short, it was a miss. Analysts already knew it would be a softer year, but the numbers still came in below what they had hoped. Morgan Stanley pointed out that the results for the second quarter missed their expectations on both core earnings and net profit. In fact, they did the math and said, if you look at the half-year performance, it's only on track to hit about 80% of what the market was forecasting for the whole year. That's a pretty clear signal of underperformance. Okay, so to really get the why behind all this, let's look at what management themselves had to say. In their report, they were actually very direct about the challenges. They said, and I'm quoting here, that they navigated its transformation phase notwithstanding the unavoidable disruptions. They gave a few key reasons. 1, it was a tough comparison. The start of 2025 was up against a really strong start to 2024. 2, the pain of transformation. They were honest that the results reflect the impact of higher costs and the temporary closure of the SCA aquarium to get the new Oceanarium ready. But, and this is a big but, the second quarter actually showed some good signs. They highlighted that revenue in Q2 grew 3%, driven by more VIPs and increased visitors to Universal Studios Singapore. So you can see a really clear picture here, right? The main casino and hotel parts of the business are feeling the heat from all the construction, while the theme park side is showing it's got real strength. So what's next? What is the company telling us about the rest of the year and beyond? Well, the guidance is all about one thing: RWS 2.0. Management says to expect more impacts from ongoing and phased closures. They're calling it an integral part of this huge transformation. But the pain is supposed to lead to some serious gain. And this is where things get really exciting. They have a whole series of launches planned. The brand new Singapore Oceanarium just opened in July. A new lifestyle area called Weave with over 40 new shops and restaurants also just launched in July. And get this, in October 2025, they're launching the Laurus, which is Singapore's very first all-suite hotel with Marriott's super fancy luxury collection brand. The vision is clear-cut. By the time they are done in 2030, RWS is going to have a whole new suite of attractions and experiences. They are building a totally reimagined resort. All right, so how did the stock market react to all this news? This part's pretty interesting. On the day the results came out, Genting stock actually closed up just a little bit. The real reaction came from the analysts the next day. Morgan Stanley downgraded the stock from a hold to a sell, and they slashed their price target. That's a pretty bearish move. But on the flip side, another firm, UOB Kay Hian, kept a more positive long-term view. They're seeing this short-term weakness as a potential opportunity. They're pointing to the nice dividend and the growth that could come once all this construction is finally done. And honestly, this split reaction perfectly captures the investor's dilemma right now, doesn't it? Short-term pain versus that potential long-term gain. Okay, let's put this all together. What does this really mean for us as investors? This is a classic pardon our dust situation. Genting is in the middle of a disruptive, expensive, but let's be honest, probably very necessary overhaul. So the bull case, the good news, looks like this. 1, if they pull off this $4.5 billion project, it could drive incredible growth for years. 2, they're still paying a solid dividend of over 5%, backed by a really strong balance sheet with a ton of cash and no debt. And 3, they're one of only 2 casinos in Singapore. That's a huge advantage. Now for the bear case, the risks. 1, big construction projects are tough. Delays and cost overruns are always a possibility. 2, the financial results are probably going to stay soft for a while. And 3, a shaky regional economy could still hurt a casino business. Ultimately, investing in Genting Singapore right now is a bet. It's a bet on the successful payoff of this massive RWS 2.0 strategy. It's going to require patience and a long-term view. The next year or so will be really telling. So there you have it, a deep dive into Genting Singapore's latest earnings. It's a company in a huge state of transition, trading today's profits for what they hope will be massive future growth. The disruption is definitely real, but so is the vision. I'd love to know what you think. Are you bullish on this big transformation, or are the risks just too high right now? Drop your thoughts in the comments below. And hey, if you found this breakdown helpful, do me a favor and hit that like button. And of course, please subscribe and turn on notifications so you don't miss the next video. Thank you for watching, and I'll see you in the next one.